Ever feel like you're looking at a trading chart, but you're missing something? Like, you only see half the story.
Oh, absolutely. Just relying on the patterns, the shapes,
Yeah,
it can leave you blind to what's actually, move in the market.
exactly. And that's what we're trying to cut through today. We're doing a deep dive based on a really interesting YouTube video a listener sent over. It's all about liquidity.
Right. A key smart money concept.
Yeah,
That sounds a bit uh, jargony, don't worry.
yeah, we're going to break it down.
Our goal here is really just to pull out the core ideas from that source video.
Mm.
What is liquidity on a chart? And crucially, how can you spot it?
Because understanding this could genuinely sharpen your trading skills. Maybe even, help you become more consistently profitable. That's the potential benefit here.
hmm So our mission, if
Yeah.
you like, is to take that explanation of liquidity and make it super clear, practical, actionable for you.
Okay, let's get into it then. What is liquidity fundamentally in trading?
Well, at its heart, trading is just buyers and sellers, right? Finding each other. For a trade to happen smoothly, you need someone wanting to sell, someone wanting to buy at the same price. The video uses a simple example.
Okay.
Imagine a seller wants to offload, say, 1,000 shares. But right now, only buyers for 800 shares exist at that price.
Ah, so there's a mismatch? Those other 200 shares? What happened?
They just sit there waiting. The seller can't fill their whole order instantly, and that illustrates a lack of perfect liquidity. Not enough buyers right then to soak up all the selling interest.
Right, an imbalance. The video mentioned that transactions can't fully complete sometimes because of that.
Exactly. So, liquidity on a chart. It boils down to finding the areas where the most buyers and sellers are active. The hotspots, you could say.
Hotspots, okay, like high traffic zones on the chart.
Precisely.
Hmm.
And the video suggests if you've watched other chart reading stuff before, you'll start to see how these zones form as we go.
Gotcha. So we're looking for where the action is concentrated. The video then points to specific chart patterns. It starts with equal highs and equal lows. What's that about?
Okay, so equal highs and lows. Picture the price hitting roughly the same ceiling multiple times. That's equal highs.
Huh.
Or bouncing off the same floor level again and again. Equal lows. Price just keeps getting rejected there.
Right, I've definitely seen those patterns. Where does the liquidity come in?
Okay, this is where it gets interesting. Think about sellers. They see those equal highs. Maybe they think, okay, price is going down from here. They enter short. Where do they put their stop loss?
Ah, just above those highs, to protect themselves if it breaks out upwards.
Exactly. And what is a seller stop loss? It's a buy order, waiting to be triggered.
Ah, right.
So just above those equal highs, you get this cluster, this pool of buy orders. And conversely, buyers entering near equal lows.
They'll put their stop losses just below those lows, which are
Right.
sell orders.
Precisely. Sell orders waiting to be hit if the price drops.
So above equal highs, buy side liquidity. Below equal lows, sell side liquidity. Okay. The video called the space between them a price imbalance or a no trading zone. Why is that?
Well, it comes back to basic supply and demand, doesn't it?
Yeah.
If there are way more buyers than sellers in an area, price tends to get pushed up. That's an imbalance,
And vice versa.
right? And that no trading zone idea, it's because things can get choppy and unpredictable in there until those pools of orders above or below are actually, tapped into.
It connects back to that old rule, buy low, sell high. You don't want to get caught buying right in the middle of that potentially messy zone.
Exactly right. So these areas with all the stop loss orders piled up, they become magnets for price. The video points out if price breaks through those equal highs
Mhm.
and importantly stays above,
Uh-huh.
all those buy stops getting triggered can seriously fuel a strong move upwards.
Because the sellers are forced to buy back their shorts, adding more buying pressure. Makes total sense. But the video also warns about traps here, right? Stop loss hunting, fake breakouts.
Yes, absolutely critical point. The bigger players, the smart money.
Sure.
They know retail traders put stops in those obvious places.
So they can manipulate price.
Sometimes, yeah, they might push price just enough to trigger those stops above the high or below the low, grab that liquidity for their own large orders, and then let the price snap back.
Wow, okay. That's the stop hunt.
That's it. So the video stresses don't just jump in the second it breaks. Wait for some confirmation. See if the move has legs.
Right. Patience is key. That initial spike could just be a liquidity grab. Okay,
Yeah.
that covers equal highs and lows.
Yeah.
What about the other scenario? A bearish trend, lower highs, lower lows. Where's the liquidity hiding then?
Yeah, this is a good one. The video actually suggests, pausing and thinking about it yourself. Where would you expect the orders to build up?
Okay. in a downtrend.
Think about sellers. Some might use a trailing stop, moving it down. But others, they might have entered higher up, and their original stop loss is still way above a previous swing high.
Right. People enter at different times, different levels.
Exactly. And maybe they initiated shorts at various swing highs, so you have stops scattered above those points.
Yeah.
Now, think about the buyers trying to catch the falling knife.
They're likely getting stopped out repeatedly as the price keeps dropping.
Bingo. So their buy stops, which are sell orders, are getting triggered frequently. This means there's probably less sell-side liquidity building up below recent lows compared to a ranging market.
Okay. So if the buyer stops are getting hit, the bigger pool of untapped stop orders is likely.
Above the previous swing highs, those sell-side stop losses, remember they're buy orders waiting to be triggered,
Yeah.
all those sellers who shorted at different points, their protection, their buy stops are sitting up there.
And if price suddenly rips upwards and closes above one of those significant swing highs.
Ooh, short covering. All those sell stops get hit, sellers are forced to buy back, creating a surge in buying pressure. It can really accelerate the move up.
Makes sense.
And the video brings in trend lines here too. If you have a clear downtrend line and price breaks convincingly above it,
That could trigger more buying.
yeah, it attracts new buyers thinking the trend is reversing, and it forces sellers who are riding the trend line to bail out. More buying pressure again.
So a trend line break can signal that the liquidity above those swing highs might be the next target. And candlesticks play a role too.
Definitely. Always watch the candles at these key levels. They give you clues about the strength of the buyers or sellers. Are they showing conviction or hesitation? It adds another layer of confirmation. It's all about figuring out where those stops, that potential fuel, are located.
Okay, clear. So equal high slows, trends. Then the video shifts to different types of liquidity using a Nifty 50 chart example. What are these types?
Right. It distinguishes between external liquidity and internal liquidity.
Okay.
Using that Nifty 50 example, April 30th, 5-minute chart, external liquidity is basically the liquidity sitting at the really obvious highs and lows of the day's trading range, the major turning points.
The extremes for that period. Got it. And internal?
Internal liquidity is found around the smaller swing highs and lows within that main range.
Yeah.
The little ripples inside the bigger wave, if you like.
Okay, big swings are external, smaller wiggles inside are internal. The video said big moves often happen after external liquidity gets swept. What did that look like on the chart?
Yeah, swept or grabbed. On that Nifty chart, around 3 p.m., there was this candle with a long upper wick. It poked just above the high of the day's range.
The external high.
Exactly.
Yeah.
Sweeping the stops of sellers who were positioned there, grabbing that external buy-side liquidity. But then,
It reversed.
sharply, it shot down and eventually went after the external liquidity at the low of the range.
Whoa. So a quick jab up to take out the high stops, then a dive to take out the low stops. Where did internal liquidity fit in?
Well, before that big drop, within the range, there was a smaller internal swing high. Price briefly broke above that level. The video called it a fake breakout.
Okay.
Now, retail traders maybe saw that little breakout, thought, okay, we're going up, and went long. They'd placed their stops just below that recent internal low.
Creating a little pocket of sell-side stops.
Yeah.
Internal liquidity.
Precisely. And then the big downward move happened, hitting those internal stops on its way down to the external low.
Ah, so the sequence was sweep the external high, engineer a fake breakout to build up some internal sell stops, then plunge to take out both the internal and the lower external liquidity.
You got it. And the key takeaway the video offered was really important. If you see a clear external liquidity level nearby, be very careful trading around the internal liquidity spots.
Because those internal stops are more likely to get run over.
Much more likely.
Yeah.
They often become targets on the way to the bigger external prize. It emphasizes looking at the bigger picture, where the major pools of orders are.
That makes a lot of sense. The extremes often dictate the action within the range. Okay, great insight.
It really shifts how you look at price action.
Right. So just to wrap up what we got from the source video. Liquidity is about those high concentration zones of buyers and sellers. We can often spot them near equal highs and lows where stop orders tend to build up.
And also by thinking about where stops are likely placed in trending markets.
And we learned about the difference between external liquidity at the major highs and lows of a range and internal liquidity, the smaller swings within it.
With the key idea that external often moves towards internal, or uses internal stops as fuel.
Exactly. And this all came directly from that listener-provided source. It's about going beyond just patterns to see the order flow underneath.
It's a powerful lens to add to your analysis, definitely.
So here's something to chew on as you look at your charts next time. How might really understanding the psychology why different traders put their stocks where they do, how might that help you read this liquidity story even better? Something to think about. Thanks for diving deep with us today.